Okay, so now we have a deeper understanding of the structure of the markets and the participants and what part everyone plays when operating within it. So what we are going to look at next is when you should be trading, and more specifically the timings of all the different sessions. We've already mentioned several times that FX is a 24-hour market, but what you might not realise is that there are some basic sessions that most of the action is carried out in, that each of those 24 hours is not equal in terms of volumes and trading opportunities. What I mean by this is that as professionals, we will only generally be trading the two main sessions of the day, which are the London session and the New York session. Now there's also the Asian session, but this is generally the quietest and also pretty inconvenient for most of the main trading centres around the world to operate. So let's look at our main two sessions and understand why it's best to trade within these hours. So the biggest session is the London session, and this is what we'll be trading for the most part. This session opens at 8 AM London time and closes at 5 PM London time. These times are of course based on the stock market opening times, and in reality currencies continue to move both after and before these hours. The reason that we adhere to these hours is because this is when most professional traders in the city are at their desks and active, and so this is when we will be the most active. The New York session, of course, is based on the opening times of the New York Stock Exchange, which are 8 AM until 5 PM New York time, pretty much the same. These two sessions overlap, with New York kicking off at around about 1 PM London time. This means that the second half of the London session is full of action, as it contains not only all of the London and European based traders, but also the influx of US based traders joining it too. As you've probably guessed, the London session contains the most action out of all the sessions in terms of price movement and volume. This is when most of the speculation is taking place. Now the Asian session, on the other hand, has the same hours in Tokyo, but the different market participants are trading in a completely different way to those in the European and US sessions. In Asia, there's a lot of corporate and central bank demand flowing through the markets, as nations such as Japan are huge exporters, so most of the trades are based around this type of demand rather than pure speculation. This results in price action that is much different from the other two sessions. During the Asian session, prices tend to move in a much more subdued manner, with ranges much lower and fewer instances of volatile price action. This obviously does not mean that large moves can't happen during Asia, and they sometimes do, but it's important to understand the nature of each market before you trade it. Now, any speculation that does occur during the Asian session will most likely be happening during data releases, and these happen at the start of the session, as they do at the start of every other session, both London and New York. There are also data releases from Australia and New Zealand during this session, so those currencies can also be prone to larger moves. Another feature of the Asian session is that any large moves that happen are very often carried over into the London session. So part of your daily research should always include reading through overnight news, but we'll discuss that in more detail later on. Now, because you do not generally trade the Asian session, most of our focus is on how London-based traders will react to any events that have happened during that time. And to do this, we need to come back to the London session and understand how this works in order to trade it more efficiently. The first thing to know is that London is the centre of the universe as far as FX markets are concerned, with about 30% of all transactions taking place during the London session. Now, the reason for this is that London is a major financial centre in its own right, coupled with the fact that it also overlaps with the New York trading session. Now, the nature of this session is very heavily based on speculative trading, with major data points being released from Europe and the US at the open and in the middle of the session. This means that trends tend to start and run during London hours, which makes it easier to catch those types of move. In the end of the session, or at the end of the session, many times those trends will reverse or at least retrace as all of the European traders book profits before going home. Now, it's also worth taking a look at the New York session, because sometimes we'll be trading this, especially if there's a major economic event such as a Fed statement or announcement. Now, the most important things to bear in mind about the New York session are that this is the time when all the US data is released, and as we've already looked at, the US dollar is the most watched currency. In fact, over 80% of all FX trades involve the dollar in some way, which just goes to reinforce how market moving US data can be. The second half of the New York session is generally very quiet, and all of the volatility, the early part trends tend to die down as the European traders leave for the day. During both London and New York, these are great times to trade, and this is the main session that almost every profession in the city will operate in. Now, having said that, just because it's the London session, it doesn't mean you should necessarily be trading every single time. Quite simply because there are not always viable trading opportunities. A big part of your training here will be educating you on how to identify trading opportunities, how to take advantage of them, but also how to identify times when it's better to not trade at all and conserve all of the profits you've made. But we'll go into all that during the main training program. So what we'll do now is finish this section by looking at how professional traders actually use all this information to make money from the markets, because, of course, that's our main objective after all. So, to do this, we will now focus on the actual mechanics of a trade. Now, placing a trade in the FX markets is actually very similar to most other markets. So those of you with any experience of trading oil will find it relatively simple. So as already discussed, our main goal is to make a profit, and we do that by exchanging one currency for another with the expectation that the price will change in such a way that the currency we buy goes up in value relative to the currency we sold. The price of the pair is also called the exchange rate, and this exchange rate is simply the value of one currency compared to another. When we look at a pair, you might remember earlier we talked about how the currency on the left-hand side is the product, and that we are buying or selling, and the currency on the right-hand side is the price of that product. The official terms for this are the base currency and the quote currency. Another way to simplify this process is to think of what we're actually doing when we take a trade on a pair. Okay, so if we buy the pair, we are in effect buying the base currency and at the same time selling the quote currency. If we sell the pair, the opposite is true. We sell the base currency while simultaneously buying the quote currency. So, if the euro versus the US dollar goes up, that means the value of the US dollar is actually falling relative to that of the euro and vice versa. Okay, so trading the pairs are quite straightforward. So let's now take a look at the price itself. When you enter a trade, you'll be doing it via a trading platform. And the purpose of the trading platform is to stream prices for all of the currency pairs in real time, instantly. So you can see the price for each currency pair that you're planning to trade. As you look at the price, you will see two prices displayed. These prices are called the bid and the ask. The bid stands for the buy, while ask stands for sell. The easiest way to remember this is to imagine the market bidding the market up, just like at an auction, and then asking it down. Now, the reason we have two prices is because the market will sell to you at a very slightly lower price than it will buy from you, therefore making the bid price lower than the ask price at all times. Now, the next question, of course, is when do you actually enter a trade? Well, of course, we'll come to all that in much more detail during the main training program. But very simply, you would buy a currency when you feel that the outlook for the economy attached to that currency is looking positive, while selling the currency attached to an economy that is not looking too promising. So, for example, let's use the euro-US dollar pair to illustrate this, seeing as it's one we've already mentioned. So, if you believe that the US economy will continue to weaken and get worse, and you think that the European economy will strengthen, then you would simply buy euros and sell dollars, thus buying the euro-dollar pair. Let's look at one more example to illustrate this point further. Imagine that we believe the UK economy was going to weaken while the Japanese economy was looking fantastic. Then we would simply sell the pound versus the yen currency pair in line with these expectations, selling into the expected pound weakness while benefiting from the anticipated Japanese yen strength. Now, it's not quite enough to simply understand how to place a trade and the core reasons for doing this. We obviously need much more information and training, so that before we move on to that, I just want to go briefly over the concept of margin. You'll no doubt come across this as you study and research the topics we've provided, so it's worth covering here just before we get to the main points. Now, the best way to explain margin and trade size is to use a real-world example that we're all familiar with. And the example I'm going to use is that of eggs. So imagine you want to buy an egg. But you just don't go into the shop and buy a single egg. Instead, you need to buy a standard amount of eggs from the shop. They usually come in packs of 6 or 12 in most places. So buying or selling currencies works in the same way. You can't just go and buy a single euro, you must trade in the standard contract sizes. These contract sizes, as we looked at earlier, are called lots, and the standard lot of currency, remember, is 100,000 units of that currency. So if you're buying a standard lot of euro US dollar, then you need to basically be buying 100,000 euros. Most brokers and dealers will offer smaller lots. For example, you can trade 10,000 units or even 1,000 units if you prefer. The concept of margin trading was designed to allow you to trade larger lot sizes with very little capital in your account. This is very similar to how a mortgage works when buying a house. Okay, so the house costs $100,000 and you only have $10,000. So the bank loans you $90,000. You buy the house and its value then goes up 10%, giving you a cash profit of $10,000. Except you haven't personally made 10%, you've made 100% on your investment because you only invested $10,000 of your own money in the first place. That's the power of margin. You only need a very small percentage of your money which it takes to invest. Most brokers offer margin trading, and it obviously allows you to buy large amounts of currency with very little money down. This works very well for increasing your investments quickly in the short term, but obviously it also works in reverse. So let's now come back to currencies. If you had 10,000 in your trading account and bought 100,000 worth of currency, but this time the value of the currency fell 10%, you would now be out of the game completely and your account would be empty. Now, we'll be discussing this and leverage in much more detail later in your training, but this gives you a basic idea of how it works in FX. Another basic concept worth mentioning is that of rollover. Now, a rollover is when you get paid or have to pay interest on the positions that you hold. So this usually occurs at the close of the New York session and is based on the interest rate differentials between the two currencies that you're holding. So for example, if you're buying the pound versus the yen and the UK has an interest rate of 5%, while Japan has an interest rate of 1%, then this represents a difference of 4%. You're effectively buying the interest rate of the UK and selling into the interest rate of Japan. Thus, you'll receive daily payments to the tune of 4% on your total position. This is a very nice little bonus for simply being in a trade. On the other hand, if you're selling that pair and you don't want to end up paying the interest, you simply close your position before the New York cut each day, or the end of the New York session. The end of the New York session is called the New York cut. Now later, we'll discuss how we can really take advantage of these opportunities, but again, this should give you a good basic understanding for when you encounter it during your personal research. In trading most markets, use the term tick, okay, to describe the smallest possible movement, but in FX, we use the term, and we looked at this earlier, we use the term pip. We looked at this in the introduction to financial markets, but there are a couple of extra things you need to know about pips and how they're displayed in FX specifically. First of all, let's refresh our memories of what a pip actually is. The pip stands for percentage in point, and it basically means the smallest amount that the price can move. So if the price goes up 100 pips, then it's basically moved roughly 1%. Now, another thing to know about the existence of even smaller measures of price action. Some brokers display the price in fractions of a pip, which means that 100 pips displayed will actually be only 10 pips in movement. These fractions of a pip are called pipettes and can be confusing if you're not aware of them. So 100 pipettes only equates to 0.1% of price movement. The reality of trading is that you will not need to worry about calculating the values of each pip yourself because, of course, the brokers and the dealers do all of this as part of their service anyway. Now, if you are interested in understanding the calculation behind the value of pips, then this information is very readily available online or via the resources that are on the reading list that we've provided as part of this pack. There are also many FX glossaries freely available online that give you the definitions for all of the major terms and phrases that you will come across during your research and day-to-day trading activities. You should search these whenever you see a term or word that you don't understand. Now, before we complete this section, it's worth giving you a very brief introduction to the different types of order that you'll be using throughout your training and career going forward. An order is simply the method you use to enter and exit a trade. So, the most common type of order is called a market order. And this is where you literally click the buy or sell button, trade in that moment at the best available price. The next type is a limit order. And a limit order is when you want to place an order to sell above the current market rate or sell below the current market rate. So that when the market eventually does pull back to these levels, your entry will be executed automatically by your trading platform. We also have a stop order, and a stop order is when you want to buy a price that is above the current market rate or sell at a price that is below the current market rate. So when that price eventually moves in your direction and continues on its way, your order will automatically be executed by your trading platform. The final order that we'll look at is a stop loss order. This is quite self-explanatory because the order is designed to literally stop your losses. You place this order so that if the market moves against you more than you were anticipating, the order will be executed automatically by your trading platform and you will exit the position, thus stopping any further losses occurring. Now, you can also tailor your stop loss order to trail the price as it moves in your favour. So as you enter the move and you make more and more profit, your stop loss actually automatically move and adjust until eventually, if the price moves against your position, you will actually get stopped out with some profit that has been locked in by your trailing stop. At this stage in your learning, it's better to stick with these basic order types so that you can get to grips with the process of trading as quickly as possible. Okay, so we've gone through a fairly comprehensive look at the basics of FX as a specific market and how you'll be trading it. However, this is only the very start of your training, so you'll not be trading real funds for a few weeks at least. At the same time, it's very important to practice your skills and apply the knowledge and analysis you've learned into the real market as a measure of your development. For this reason, I encourage you to trade a test account, which allows you to participate in the real market movements but with no actual financial risk. These are often sometimes called demo accounts by retail traders, but they're basically one and the same. You'll be trading a test account after you've completed the main training program and are following the daily analysis, using the tools we provide, and attending the various coaching and mentoring sessions that we hold for you. After this, you will graduate to real funds and build up from there until you're potentially managing company money and then, of course, trading for clients. The next stage now is for you to become more familiar with the process of FX market analysis so that we can really get to grips with what moves the market and how you can take advantage of that. And we will do that with the next video in this course covering the 4 pillars to successful FX trading.